Hello friends, welcome back to the channel. If you're living in Australia or you're planning to move here, I've got something really important to share with you today because your wallet is about to feel the effects of some major changes coming in 2026. Whether you're earning $50,000 a year or $500,000, these new tax rules are going to impact how much money stays in your pocket at the end of the month. So, stick around, because I'm breaking down everything you absolutely need to know about tax offsets, home buyer incentives, and investment tax changes. And please, if this information helps you, smash that subscribe button because we're constantly releasing content that puts money back into your hands. Now let's dive in. The Australian government has been under tremendous pressure from everyday workers who are struggling with the cost of living, rising mortgage payments, and the stress of trying to save for a home. You feel it too, don't you? That anxiety when you see your paycheck and realize how much has already been taken out. That worry when you think about your future and whether you'll ever be able to afford your own place. That frustration when you see investment opportunities but feel like the tax system is working against you. Well, the government is listening, and they've decided to make some substantial changes that could genuinely improve your financial situation in 2026. Let me start with the tax offsets because this is where most of you will feel the immediate benefit. A tax offset is essentially a reduction in the amount of tax you actually pay, and it's different from a tax deduction because it comes off your final tax bill rather than just reducing your taxable income. The new rules for 2026 are expanding several key offsets that could save you hundreds of dollars. If you're a low to middle income earner, the government is increasing the low and middle income tax offset, which means you'll get a bigger refund when you do your taxes. Think about what that money could mean for your family. Could it finally cover that dental work you've been putting off? Could it go towards your child's education? Could it be the buffer you need when your car breaks down unexpectedly? These aren't just numbers on a spreadsheet. They're real money that affects your real life. The government is also introducing new offsets for people who've been hit hard by specific circumstances. If you're caring for a family member, if you're a volunteer firefighter or SES member, or if you're dealing with medical expenses, there are new offset provisions that recognize the burden you're carrying. This is the government saying to you, we see what you're doing. We understand it's costing you money out of your own pocket, and we want to help ease that burden. The emotional weight of caregiving or community service is real, and now the tax system is finally acknowledging that. There's also an expansion of offsets for people investing in renewable energy or making environmentally conscious choices. If you've been thinking about installing solar panels but were worried about the upfront cost, some of these offsets might actually make that decision much easier for you. Now, let's talk about homebuyer incentives because for many of you watching right now, owning your own home might feel impossible. The housing market has been brutal. Prices have skyrocketed while wages have stagnated. You've been saving every dollar you can, skipping holidays, cutting back on entertainment, living with your parents longer than you wanted to, all in hopes of getting a deposit together. The government understands this pain point intimately because they're hearing it from voters constantly. Young families who are renting and terrified they'll never own. First-time buyers who feel like they're running an impossible race. People who are aging out of their earning years without ever achieving the dream of homeownership. The new homebuyer incentives coming in 2026 are substantial. There's an expansion of the First Home Super Saver scheme, which allows you to put money into your superannuation that you can withdraw as a first-time buyer. This is genuinely powerful because it combines tax benefits with your retirement savings strategy. Basically, you can contribute to super with pre-tax money, claim a deduction, and then later withdraw it for your home purchase. It's like the government is giving you a hand up the ladder. But it goes further than that. There are new grants and financial assistance programs specifically designed for first-time buyers in regional areas, because the government recognizes that housing affordability is worse in major cities, but that regional communities also need population growth. The stamp duty concessions are also being expanded significantly. Stamp duty is that huge tax you pay when you buy a property, and it's often been the killer blow for first-time buyers who've managed to save a deposit. These new concessions mean you'll pay less or potentially nothing on your first home depending on where you live and how much you're buying for. Let's say you're buying a $400,000 apartment in Sydney. Under previous rules, you might have paid $30,000 or more in stamp duty. Under the new rules, that could be cut dramatically. That's money you can put into renovations, furniture, or just having a safety net for emergencies as a new homeowner. And for those of you buying in regional areas, the concessions are even more generous because the government is actively trying to encourage population distribution away from the major cities. But here's where it gets even more interesting. The government is introducing new incentives for first-time buyers who are purchasing properties that need renovation or that are in underutilized areas. If you're willing to buy something that needs work, you get additional tax breaks. This is brilliant because it means someone can buy an older house, renovate it, and both get tax benefits while also improving the housing stock. You're not just buying a home, you're potentially building equity faster through renovation, and you're being rewarded for it through the tax system. This is the kind of win-win scenario that can genuinely change lives. Now, let's move into investment tax changes because this is where things get more complex but also more important, especially if you've got some money and you're thinking about where to put it. The tax treatment of investment income is shifting in 2026, and you absolutely need to understand this because it could mean the difference between a smart investment strategy and an expensive mistake. Capital gains tax is the tax you pay when you sell an investment for more than you bought it for. The new rules are adjusting the capital gains tax discount, which previously allowed you to only pay tax on 50% of your gains if you'd held the asset for more than a year. These changes are being framed around creating fairness in the tax system, but they also mean that longer-term investors are going to see their tax bills increase. If you own investment properties, this is crucial. The tax treatment of rental income and deductions is being scrutinized more carefully. The government has become increasingly concerned about investment property investors claiming excessive deductions that reduce their taxable income while properties appreciate in value. The new rules are tightening these loopholes. However, and this is important, legitimate expenses like mortgage interest, property management fees, maintenance costs, and capital works allowances are still deductible. You're not going to lose those. What's changing is that certain claims that were previously gray areas are now being clarified, and they're generally being clarified in a way that means less deductibility. This might push some property investors out of the market, which could actually mean more availability for first-time buyers, but it also means existing investors need to reassess their strategies. For share market investors, the changes to capital gains tax treatment are significant. If you've been holding shares long-term, expecting to get that 50% discount, you need to reconsider your timeline. Some of the new rules might mean that holding period requirements shift or the discount rates change. This doesn't mean you should panic and sell everything, but it does mean you should probably talk to an accountant or financial advisor about whether your strategy still makes sense under the new rules. The government is also introducing new rules around tax avoidance schemes, and this is where emotional trust comes into play. You need to know that the tax system is fair, that everyone is paying their fair share, and that no one is gaming the system in ways you don't know about. The new rules are designed to close down schemes where people use complex structures to minimize their tax bills in ways that most ordinary workers simply can't access. Whether you agree with those rules or not, the intent is to create a system that feels fair to everyday people. Friends, these changes are coming whether we like them or not, so you need to prepare. Talk to a tax professional about your specific situation. Start planning now if you're a first-time home buyer. Review your investment strategy if you have one. Don't let 2026 surprise you. Please hit that subscribe button if this video has helped you understand what's coming, because we're going to be releasing detailed guides on each of these topics as we get closer to the implementation date. Your financial future matters, and you deserve to understand the rules that govern it. See you in the next one.